In this week's update, volatility surges. Is this a new normal? Growth is getting the accolades it deserves. And where will you get your financial literacy to combat AI scams? My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Wow, what a week. Incredible volatility in response to earnings season in Australia and all sorts of global events. So let's get stuck in and have a look what was driving markets and where they may be heading towards the end of the year. In America, some less than ideal jobs numbers on Friday night now has the market virtually 100% pricing in a September rate cut of 25 basis points, and possibly 50 basis points is not off the table either. So the markets are going to love that. The only problem is that part of the reason for the rate cuts are reasons that you really don't want to see, and that's a weak labour market, and hence that raises the possibility of some sort of recessionary conditions. So not ideal. But the market also cheered some incredible progress at the fundamental level for companies. Companies beating top and bottom line, raising guidance by significant amounts, by much more than the market was expecting, and producing just golden numbers that you really want to see, and they're not expensive compared to the growth. So there's still upside despite the fact that some stocks have been in great trends for a year or two. The price rise has not really exceeded the growth rate in earnings by all that much, which makes it more sustainable. So my view remains extremely positive. It's the only conclusion that one can draw towards the end of the year. However, we do have a market that is very much a market in separate halves. We've got the haves and the have-nots, and you certainly don't want to be owning the have-nots because they get treated very badly. So overall for the US market, there are a few pockets of excess. There are some meme stocks. There are some crazy moves being supported by irrational reasons, but they're relatively limited. My view of earnings season in America and also in Australia is that stocks are being treated more on their merits than I've seen for a little while, both good and bad. So stocks have been slammed in the negative direction where it has been warranted. And it's a sign of a healthy market. And just as one example, I won't quote the company, but certainly Insiders Club members know very well which company this is in America, because it's been a hugely profitable investment for us. In Q2, they beat on the top and bottom lines. This is just to give you an idea of what's going on. They then raised guidance for FY25, revenue guidance by 25%. They also raised earnings per share guidance, and earnings per share are expected to grow 42% year on year, and yet the PEG ratio is still comfortably less than 1 for FY26. So that means that valuation is not an issue here. It's not getting out of control. The return on equity and return on invested capital percentages are rising very sharply, which is hard to do. And margins are growing very robustly as well, profit margins. And free cash flow, it's the same story. This is real. This is not counting trickery. These are real cash flowing through the business. And this company is a massive beneficiary of what's happening with the expansion of data centers around the world. And I saw an unconfirmed suggestion during the week that Meta may be spending something like $600 billion from now until 2028 on data center expansion. And that means that the beneficiaries down the line, all the way down the food chain, are going to benefit. So that's sustainability, in my view, with that sort of tailwind. So that's what's happening in the US market. And just on that stock, just as perspective, no surprise, the price is up 1,600%, so 16-fold in the last 2 years. Yet it's still not expensive. So forget owning the traditional household names, the names that the industry tells you you need to own because that's just how you do things. Forget all that rubbish. Just go and find these stocks. And we've identified plenty of them. So monitor all the stats that you want. But at the end of the day, you want to see your account value go up quickly and safely and reliably. That's what you want to see. The stats don't matter. That's just perhaps a means to an end, but it's not guaranteed. And events like last week, where we got a nearly 2% plunge in the Australian index on Wednesday, and many stocks got absolutely smashed, it scares investors out of, they may be in some fabulous positions, but it just scares them out of it because they don't really understand what's going on. And all they see is plummeting prices and all the conjecture about what might be driving it and how things are going to go to the end of the year and recessions and market crashes and all that sort of thing just overwhelms people, and they jump out of what really are good positions. So it gets back to having what I rabbit on about every week, having a simple game plan and prepare in advance. Just spend a couple of minutes. I mean, this is not difficult stuff and it doesn't take very long. Just spend a couple of minutes thinking about if the market signaled to us that we need to take some sort of evasive action, either by reducing exposure, putting in place some hedging, whatever it might be that's appropriate for your game plan. If that were to occur, just think about what your response would be. And in a lot of occasions, the response of doing nothing is generally okay. And it's often generally the best response. So I'm not saying that there's necessarily things that you need to do here. But just that pre-thought, knowing how you would respond to a situation, it just prevents the angst and the crazy decisions if the market does go off the boil. So that is what produces the results that investors want, well above 10% a year, but rarely get because they just don't have the plan in place and they don't do the preparatory thinking. And it's not difficult. It really isn't. Now, just a final point on AI, because I talked about this last week and I've been talking extensively about it in the memberships. But AI studies are now starting to show it's not going to be an automatic silver bullet for companies just because you jump into that camp and you do certain things and you implement stuff. Studies are showing that companies are not necessarily getting the benefit of what AI can provide. And a lot of that is happening, particularly with larger companies. Larger companies are failing to get the benefit of AI because, and the studies are concluding that it's largely because of their bureaucracy. They're slow to move, slow to change things. Smaller companies, and that's why we're starting to see some very, very significant moves in the smaller cap sectors, both in Australia and in America. These companies, they're more nimble, they're more able to take advantage of the benefits that AI can provide. So a minority is going to excel to an extraordinary degree that we probably can't even contemplate. And the example I just mentioned before, the 1,600% gain over 2 years, is typical of what we're going to see going forward. Smaller companies that are agile and nimble and can respond and use all the tools at their disposal are going to do extraordinarily well. And so can investors that just clear their mind of all the junk, the mainstream investing junk that is put out there, which in Australia, the earnings season that we've just had proves is a lot of it is junk. Clear that out of your mind and just get focused on the relatively small number of stocks that are going to do outrageously well. Now, I also just want to touch on financial literacy because there's been a bit of press about this lately. Scams are getting more and more sophisticated, and I think it's just a matter of time before the majority of us get touched in some way by financial scams. And unfortunately, it's the less knowledgeable investors that are most at risk. So it's a real problem, and it's one that you really shouldn't stick your head in the sand and ignore and assume that it won't touch you because you're smarter than that. You don't click on things, you don't get talked into things, but they're getting so clever, so sophisticated these days that you really do need all the protection that you can possibly get. So what does that require? What does financial literacy actually require. So for me, it's a little different to the way most people would think about it. Think about financial literacy as knowing something about economics or something. That's not it at all. For me, it's about having a set of tracks to follow, so a plan, and then a process that helps keep you on that track, because it's so easy to be thrown off track by the media, by the thoughts in your head, your biases, your previous experiences. Those things can all throw you off track and do throw you off track unless you have a very clear plan. And the clearer the plan, the less likely you are to be lured by these scams. The prospect of significantly better returns than what you're getting. That's what these predators are relying on, that you become desperate for a better return. And so you give it a go. But if you're already getting a better return and you've got a very settled process, then you are less likely to be lured into all these scams. So what does that look like? What does a set of tracks look like? And I talk about this multiple times a week in our services, and it's very simple. It's about choosing the sectors that are going to have high probability growth for years and years and years to come. And of course, breaking the sectors down then also into sub-industries. So understand what your weightings are, what style of stock is appropriate or more appropriate for you. And you can have a mix, of course. And by style, I mean size. If they're a miner, are they a producer or a developer? If they're an industrial company, are they profitable or are they still in development phase and not yet profitable? What is the mix that is suitable for you? Now, this might seem difficult if you've never done it, but honestly, it is just so simple and obvious. And this is what I step new members through in an induction process, helping them sort out their thoughts. So sort out what are the sectors and the weightings. And then, of course, the next logical step is, well, within each one of those sectors, what is the best of the best? What are the best stocks? Where is the highest growth and the highest reliability? And those the two things go in combination. And then the final thing is really just the nuts and bolts. It's just the simplicity of a repeatable entry, repeatable exit, and repeatable risk management process as you go along. And the clearer that all that is up front, then the less likely you will make crazy decisions when we have the sort of volatility that we saw in the last week. And that, of course, leads to you've just got to get all the advice that you need so that you are less likely to be lured into scams. All right, let's look at American stocks now. The S&P was up 0.3 in the end. The Nasdaq did better and rose by 1.1%. A good slice of that was due to Google and Apple. Google had their antitrust case not necessarily completely removed, but certainly the potential penalties were nothing like what the market expected they could be. So that made a good contribution to the Nasdaq. But the Russell was also up 1.1%, so we're seeing good breadth in America, which is a good thing. Economic data, particularly on Friday with the jobs data, makes rate cuts almost essential now. They've moved beyond the will we do it, will we wait a bit longer, will we watch some more. We've now clearly got a trend in a weakening labour market in America. And that's not really the reason you want to have rate cuts, because it means that the economy is going off the boil. And hence it's even more essential that you own stocks where that doesn't matter, where the general health of the economy doesn't really affect their business performance. It's even more important now. So we are seeing massive bifurcations opening up. In our model portfolios, we had gains anything up to 25% just last week in stocks that we own. Now, we had one or two go down, of course, but overall, it was an outrageously net positive week. And so we're seeing these massive differences between stocks that are doing well and the stocks that aren't. As I said, Google was up 10%, but gee, there are just so many powerful continuations of trends that have been running for several years. And when you look at the fundamentals and the valuations, there's no reason why these trends can't continue. US dollar index came in at 97.74, not a lot of movement for the week. The 10-year yield, which had pushed up towards 4.35, suddenly fell back to 4.06. So there's been some very, very wild swings in the bond market. And the VIX kicked up a little bit from 14 to 15 over the last couple of weeks, but not much fear in the market. That's what that is saying. All right, let's look at the indices now. On a weekly chart, this is the S&P. You can see it wasn't a huge range for the week, but we certainly had buying and selling extremes on both ends. We've got little wicks on both ends. We've got a market that's moving forward, moving back, and we're getting a bit of a transfer of control backwards and forwards, even on an intraday basis. Let's just look at the Russell while I'm here. So there's the Russell on a weekly chart. So we're trying to push up to the all-time highs. The NASDAQ, which is the most important one that I follow, again on a weekly chart, setting new all-time highs and new all-time closing highs as well. And that's clearly still a very strong uptrend. This is the NASDAQ versus the S&P. So you can see we had this downturn in February, March, and the first week of April, which was about tariffs and tariff uncertainty. But since then, growth has certainly, and technology growth has certainly outperformed the S&P. So that's a very strong move in terms of preferencing the NASDAQ. If we look at consumer discretionary versus consumer staples, Amazon is ticking along quite well, and so that is helping that sector. Clearly, that's not showing that markets are getting nervous at this point in time. Importantly, semiconductors on a weekly chart, we're almost at all-time highs, so there's been no deterioration there. And this is what I'm looking for. I'm looking for a change in the balance between who's controlling the market. And there is nothing here that the market is saying. We can look at the market from two perspectives. We can look at the fundamentals, and we can make an assessment of whether the fundamentals are deteriorating or not. So that's one level. But it's the less reliable way to look at it, because fundamentals often do not translate to the price movement that you would expect. Or you can look at it the other way, and that's just the price movement, which is what I prefer to do substantially, and just say, well, who's in control here? And clearly there is no change of control here. Who's driving the market? When we look on a sector basis, XLC had a really good week. That's certainly stock specific. XLV also did quite well. Banks came off to a degree, and technology bounced a little, but technology has certainly not been the leader of late, which makes those index moves even more impressive. It just displays the breadth of the market advance. In Australia, this red line here, XSO small caps, that's a very broad church, of course, but they're the consistent outperformer over the last month. Day after day, week after week. Terrific small caps that have been there. They've been there all along, since before 2020. It's just the market wasn't recognising them because it was so fixated on the top 50 or top 100 stocks, because that's how you do it. Well, I've been bleating all along that if you want above average results, then that's not how you do it. And earnings season has just shown very clearly. All right, that's where the money flows are going in the markets. Just check in on the currencies. There's the US dollar. We've been pretty much anchored here. It's been a bit volatile, but we've been anchored here since the middle of June. And when it comes to the Australian dollar, it hasn't gone up as to the same degree that some might have thought, particularly given strength in commodity prices. So that one is still unfolding. So turning now to the Australian market, our dollar is just under 65. And it's really about global risk aversion holding the Australian dollar back. which is what often happens. We had a strong July trade surplus, which should have been positive and probably did have a positive impact. Without that, the Australian dollar was probably even lower. And we've got a technical support zone just above 64 cents. So I think the likelihood is, and this is just about probabilities, this is not a prediction, the likelihood is that we're going to stay somewhere in this sort of 64 to 67 exchange rate area, probably through to the end of the year. But look, who knows? I don't worry too much about it. Now, the Australian index fell 1.15% for the week, but probably a positive start on Monday. Last week was the most volatile response to earnings season on record. It's never been more volatile in terms of the daily response on the earnings announcement. So is this just market dynamics, or are investors waking up to flaws in accepted wisdom? I think it's the first one. I wish it was the second one, because frankly, there's just so much rubbish out there. Honestly, I read over the last couple of weeks recommendations to buy stocks that have just had really bad announcements due to structural reasons. These are not one-offs. These are structural problems that these companies are encountering that are going to last for some time. And yet there are still buy recommendations. The prices have been smashed and there are buy recommendations out there. I just find it extraordinary. Anyway, move on. So bond markets quite volatile during the week, and they were the tail wagging the equities market with some pretty wild swings. Gold stocks were massive around the world, but particularly in Australia and also America. Niche small caps, some massive gains in niche small caps. Very exciting and terrific outlooks. But there are also so many abject failures over the last couple of weeks. Think about Woolworths, CSL, James Hardie, Sonic, QBE, Amcor, Reece Plumbing. These are all stocks that conventional wisdom says you should own these stocks. And whenever the price dips, you should buy them. Well, sorry, proper examination shows that that is not very good advice. So we'll start with the ASX 200. It wasn't a disastrous week, but this is a daily chart. But you can see Monday, Tuesday were negative. Wednesday was a shocker. And then we partially reversed on Thursday and Friday. How much of this is the dynamics of overseas institutions using the Australian market as a hedging mechanism ahead of the US session? I don't really know. But as I've said many times, I don't worry too much about what the Australian index is doing. I'm just very focused on the stocks that we own in Australia and America and what they are doing. All right, let's move now to, I'll just look at Bitcoin. So Bitcoin finished the week at just under 111,000. Now, silver had a fairly quiet week, really. It did trade a little bit higher, got up above 41, almost to 41.5, and then eased and finished around that 41 level. But nevertheless, you can see that is a very strong trend in silver, and there's really not a heck of a lot of resistance until you get close to $50. Gold in US dollars on a weekly chart finished at 35.86, and in Australian dollars we did have a close at 54.71. There's actually something amiss with these charts. They're actually showing not much movement. So in fact, it's actually showing, now that I look at it, it's showing the following weeks. That one there can be, that last candle can be ignored. So that candle there can be ignored. So that's really all you should be looking at. That was last week in US dollars, and that was last week in Australian dollars. No wonder the Australian gold stocks are doing as well as they are. And if we look at GDX, the Aussie index, you can see just how strong that was for the week. We had a gap up to start, and then it really traded very strongly after. So precious metals, gold up $220, almost to 3,600. or 5,500 in Aussie dollars. The gold market did well because bond rates at the end fell, and that helped drive the more than 6% gain in the gold price. Add on top of that, all this geopolitical risk, the policy risk about what Trump's going to do next, the expectations of a rate cut, central bank buying, just technical momentum in the market. It's also very positive. Now, when it comes to gold stocks, the costs are rising, but the margins are expanding quicker because of the rising price, and that's just throwing off very abundant free cash flow. So again, these price rises in gold stocks are well and truly justified. They had failed to provide the leverage that they normally do, which is something like 2 to 3 times the percentage move in the gold price. We hadn't seen that for some time, but that leverage to the underlying metals is now really kicking in. Other commodities, copper, unchanged. We remain range bound there, and crude oil fell a bit down to just under 62. Now, just to wrap it up, final thoughts. What is going to dictate your portfolio return for the rest of this year and for years in advance of that? And the overall theme of the video this week, as it often is that there are just so many accepted wisdoms that are just irrelevant. They're simply plain nonsense, and we saw that reflected through the Australian earnings season. Companies got absolutely murdered, and I'm sure a lot of investors who are not too close to the market were stunned by the way that these top 100 companies are treated. And, it's about time. So question everything, demand proof one way or the other, and only indulge in the highest probability growth. I do not understand the concept of a balanced portfolio. To me, that just says you either don't or you can't do the homework required to select the best part of the market to be in. It's not that difficult, particularly if you've got an environment that is looking at things very realistically. Last week demonstrates that we should be forgetting about what the general market is doing. It doesn't really matter. Focus on individual success stories, the best of the best, and the performance that those businesses are racking up quarter after quarter. Our portfolio analyst last week, taking stock was supposed to happen. It's going to be delayed for unfortunately logistical reasons. That was why there was no Sunday video last week. But everything's back to normal now, so taking stock will be appearing during this week, and there's some very good questions. I think it'll be a very productive session. That's it for this week. More information on the website. There's my email address. And I will be back with you next Sunday. Cheers.